I'm here to introduce our webinar today on behalf of the El Dorado Community Foundation, as well as the El Dorado Community Foundation Plan Giving Committee. This event is taking the place of our normal Serrano event, which we have every May. And we're assuming that next year we'll be able to have our normal event and we'll be able to meet and greet people and shake people's hands and potentially even hug people, who knows. But I did want to talk a little bit about the discussion today is going to be emerging from the pandemic, economic trends for the Sacramento region. But I did want to just introduce and give you an idea who's on the Plan Giving Committee. The members of the Plan Giving Committee are Catherine Heath, who's co-chair along with Jeff Wood, Jenna Ellerman, Dan Stazak, Sil Reggiardo, Joe Grant, Tina Collins, and Chris Reeg, and then Bill Roby and Lois Roberts are our great support people from the foundation. The other thing I want to talk a little bit about is we now have an advisors giving circle that we use to network with other people in our professionals. And what we do is we share resources. And the idea of the circle is to go ahead and to make grants out of the foundation to local charities or needy people in the organization. So if you want to join that, just let us know, or you can go to the El Dorado Community Foundation website. So without further ado, I'm going to go ahead and introduce our qualified speakers here. We have three. We have Joe Niehaus. He's a vice president of finance for Golden One, where he's responsible for managing treasury, profitability, and financial analytics. He has his MBA from the University of Nebraska. He's a certified chartered financial analyst, and he's worked as a bank examiner, both public and private sectors. Nick Haladic works with Joe as a senior quantitative modeler for Golden One with an economics degree from CSU, California State University, I'm assuming Sacramento. He was previously a senior research analyst at the Greater Sacramento Council. And then we have Bob Shanahan, who is with Collier Real Estate. He entered the commercial real estate business at the start of 2015 in Seattle and Bellevue office. He's a research associate, accumulated more than 6 years of riveting commercial real estate experience. Bob is a native Sacramento, relocated to Sacramento in 2017. He's worked at Sacramento Colliers since mid-2018. He supports 20 brokers in his office with industrial, retail, multifamily, healthcare, and capital markets disciplines. Over the years, Bob has learned how to synthesize market trends into an easy, digestible narrative for his internal and external clients. Bob publishes local quarterly market reports, releases regional reports and pitches, and business development, handles media relations, and tracks the local real estate market, which is why we have him here today, collecting data on leases, sales, development, tenants, investors, and other relevant trends. Bob now manages the Sacramento and Reno offices and is increasingly taking on regional leadership roles with Collier Northwest region. So without any further ado, I'm going to have Joe start the seminar for us, and there will be the ability to ask questions through the chat function or the Q&A function at the bottom of your screen. And please go ahead, Joe, and take us through the.
All right. Is everyone seeing the screen? Should just be. You guys see it there, Bill? Yep. Okay. So thanks for having us today. I know at least I can speak for Nick and I assume the same thing for Bob. Appreciate the opportunity to meet with our other, regional stakeholders and just discuss things, all things economics and what can potentially be impacting the region. So we're going to take a look at a few kind of high-level themes today. We'll look at capital markets trends. We'll take a look at how those capital markets trends are impacting our regional financial institutions. Nick will go into our regional labor market, what's been hit the hardest from the pandemic, what's showing some sign of recovery. And then Bob will take us home with some really great insights for both the residential as well as the commercial real estate markets within the Sacramento region. So with that, I will get going here on the topic of capital markets. Again, a lot of this is going to be at the broad national level, and then we'll try to discuss how that kind of comes back and impacts the region. I will say as we go through this, we'll do our best to keep track of questions if they come up during the presentation. Given timing, we may try to push some of those to the end, but we'll do our best to maybe take a moment here and there throughout and make sure we can address any questions that come up. So I'll go ahead and get into it. I think one of the big questions today is how do you know if you're in a bubble? And I will say, I'd recommend you appreciate this slide because it'll be the last one that's not a line chart for probably half the presentation at this point. But a little levity to get going here. But I think bubbles kind of are the topic these days in the financial markets. And it's pretty easy to see why. So here, we're going to look at kind of a few different sectors of the financial markets. So in the top left of the screen, we see the S&P 500 index. We can see that it's reaching all-time highs. Now, granted, we're only showing back till 2007 here. However, reaching all-time highs almost every other day. We'll have some pullbacks here and there in various weeks, but obviously stocks have done well, year to date, as well as just kind of thinking back to the pandemic when everything really took a hit, performing very well from a price standpoint. If we look to the chart to the right of that, so high yield, I kind of went straight to high yield, just thinking, the investment grade bond sector is kind of doing well because they've had a flight to quality for the most part. But so let's just go straight to the high yield sector, also known as the junk bond sector. How are prices doing there? Again, seeing, record highs in a lot of cases. And what that does is when those prices are bid way up, it takes yields way down, which is very consistent with what we're seeing, in the treasury markets and across the board when it comes to interest rates. The chart on the bottom left of the screen is an interesting one these days. So that's Bitcoin. Now, Bitcoin only goes back to the 2010-ish time frame, where I think you could buy it for 6 cents. And just recently, it was up around the $60,000 mark. However, if you're following some of the headlines, just over the last week, it's had a little bit of volatility that's taken it down close to 30,000, I think. And then I think it's currently right around 40,000. So obviously the crypto market, cryptocurrencies, still a developing market. As somebody in the more traditional sector of finance here, working for a credit union, there appears to be a lot of headway that the cryptocurrency markets have to make in terms of their viability, their stability, how they ultimately mesh with some of the, I guess not some of them, but a lot of the regulatory environment that a lot of us in the standard financial markets have to deal with on a day-to-day basis. So a lot to see there, but nonetheless seeing all-time highs in that sector. And then if we go to the bottom right, we can see home prices also at record highs. We're showing the Case-Shiller index here for at the national level. And I think in our region, we're seeing it every day, right? We're seeing a lot of migration out of the Bay Area to the Sacramento region. We're seeing people outside of California of means moving into the region, bidding up prices. I think it's pretty much standard practice to have homes going much higher than asking. Bob may touch on this a little bit later in the presentation, but obviously seeing record highs there as well. So, the headline of this slide is like we're in the Himalayas. There are mountains all around us. It's pretty hard to go and find a sector that's not performing well. And then we'll kind of get into why that may be here on the next slide. So sticking with the theme of trekking through the Himalayas, we have a few guides taking us there, and their names are Ben, Janet, and Jerome, obviously tied to those who have headed the Federal Reserve over the last 15-ish years or so, probably not quite that much, but I think what's key about this chart, so all we're showing is the Fed's balance sheet, right? So the Fed is a bank, similar to a lot of other banks. It's going to have assets, it's going to have liabilities. But so in terms of assets, the Fed has been out there buying a lot of treasury securities, a lot of mortgage-backed securities that are issued by the large government-sponsored enterprises, Fannie Mae, Freddie Mac. And so they're taking all of those on their balance sheet. When they buy all those securities, all that money that they use to purchase those goes out into the system. At the same time, the Fed's buying activity helps. It's a lot of demand, right? So the prices are bid up. Again, another case where yields are coming down. Fed is doing that to help keep the financial system moving. Low interest rates help do that. Again, just as a friendly reminder, interest rates are simply the price of money. So if you can drive interest rates down, you make money cheap. The idea is you can help the economy run as fast as it can, given where interest rates are. And obviously with the pandemic, with the pullback in economic activity, a lot of the negative GDP numbers we saw, I think technically we're still in a recession. I haven't seen the official, statement that we're out of a recession, but nonetheless, we have had challenges on the economic front. The Fed's doing everything it can, and I would feel pretty good about saying all the Fed's activity in the markets is helping those peaks that we saw in the previous slides. When you pump that much liquidity into the market, that liquidity needs to find a home, and it's finding homes in equities, bonds, crypto, and home prices as well. So kind of moving on from here, I think it's important to kind of talk about, well, we can look at, as far back as we can from a historical perspective, what do we expect to happen next, right? So the pandemic is starting to ease up a little bit. We have some light at the end of the tunnel. People, we're heading into the summer months. I think people are ready to get out, enjoy life a little bit more than they may have over the last year. They're likely to spend some money doing that. So the question becomes, what is all that demand going to be, right? So we've seen savings, and we'll talk about our financial institutions here a little bit later. Savings have really built up within the financial system and a lot of our depository institutions. And so when people feel comfortable to go out again and spend all this money, how quickly are all of those savings going to flow back out into the economy? And when you have that many dollars going after a limited number of goods, are we going to see a significant amount of inflation come from that release of the funds that have been built up? And we'll talk about that a little bit later on the next slide. But we just wanted to quickly cover, here's the long-term trend of interest rates. We've been on a downward trajectory for the last 40 or so years. And, interest rates do, as the chart shows, move in generational cycles, right? Decades-long cycles, greater than your typical 7 to 10 year business cycle. So it's hard to make an argument that things don't reverse and we start to get a more structural shift of higher interest rates, but it's also hard to think how well can our system really withstand higher interest rates, given that we've kind of gotten used to this low interest rate environment. I think as we'll quickly cover, so inflation, as we briefly mentioned, when inflation goes higher, it's too few, or I guess too many dollars chasing too few goods. So when that happens, our central banks are kind of going to do the reverse of what they're doing now. They want to take actions to try and pull dollars out of the system to help mitigate that inflation. And so that's kind of what the big topic of the day is like, how is the Fed, going to keep rates low in the face of inflation? Now, the Fed will say that it's transitory, right? That it's not going to be here forever. However, that's, I don't think there's anybody at the Fed right now who's really dealt with this type of environment, right? Who's dealt with an environment where over the last couple of years, we've seen, trillions of dollars of negative interest rates around the world, right? Negative interest rates are something that are very new to our financial system. So it's hard to think that people can have a good sense of how all this will turn out. There's still a lot of uncertainty out there. And as this chart shows, inflation has been fairly muted for a while now, going back to the 90s, around that 2% target that the Fed likes to look at. But again, I just kind of want to quickly show and discuss this idea of real interest rates, right? So a good proxy is the 10-year Treasury, should try to incorporate inflation expectations as much as it can. And over the next 10 years, I want to earn real purchasing power, right? So if I buy a 10-year treasury yielding 2%, and over the next 10 years, inflation averages 2%, all I've done is actually just maintain purchasing power, right? So 10 years ago, I could buy a can of Coke for $2. 10 years from now, it probably will be different dollars, but I can only buy, the same one can of Coke with the money that I make, the money that I'm generating, right? So I haven't really improved my financial position very well. So when people are investing, the idea is to earn real returns that consistently improve your purchasing power, your ability to generate wealth. And what we're seeing these days is investors are willing to earn negative interest rates, right? So inflation expectations are greater than what you can earn on a long-term U.S. Treasury, right? Now, I think you can go back and look at total returns overall over the last cycle, and you will see that bonds, particularly treasuries, have performed particularly well, given that 40-year decline in interest rates, right? That means those prices are going up. But over the, if that does shift to a structural increasing rate environment, we're going to have to think of things differently. And I think there's, likely some significant change on the horizon for the financial markets. Now, granted, with that said, the Fed has kind of hitched its wagon to this easy monetary policy, right? We will just continue to pump dollars into the system to help the economy get what it needs to get to keep functioning. Problem that runs into is you can't really do that forever, right? Even in our current environment, the federal government is providing fiscal stimulus, helping, pumping those dollars, literally checks into the pockets of people that do need it in plenty of cases. But all that has to be paid for, right? And that's another thing to consider is years from now, are we going to have the economic activity that we need to have to help generate the tax revenues to then help actually satisfy the actions we're taking today? So a lot of uncertainty out there, and I think that's kind of the overall theme is, all prices are extremely high. And there's a lot of uncertainty. It's really hard, it'd be tough for me to sit here today and actually tell everyone I know where things are going. I think like in my role, it's just to manage the risk that we see and try to keep things as neutral as possible. But at the end of the day, there's a lot of things that people working in finance and even the broader economy have never had to deal with, right? So we're going to see uncertainty stick around for a little while, and I think I think those in charge, the Federal Reserve, will do their best to manage the situation as they see it, but we're probably not thinking of all the things that will ultimately occur and what we will have to deal with. So that's it for the capital markets kind of review. I'm going to jump into regional financial institutions and how those capital markets are impacting regional financial institutions. So just take a quick second and see if anybody wants to throw something in the Q&A box for a question. If not, we can keep going and then try to get to some of these at the end here. I'm not seeing anything at the moment. My colleagues can help me out if they do see something pop in there, but I'll keep going. So here we go for our regional financial institutions. How are regional community banks and credit unions impacted by the capital markets trends we just discussed? Here we're kind of showing that there's mountains here as well. As we've already discussed, a lot of the liquidity that's been injected into the system has built up in our regional financial institutions. What I find interesting about this slide is for our region, so I'm really just looking at the counties in and around the Sacramento area, and those financial institutions, those community banks and credit unions that are headquartered within these counties. We're not looking at assets by Wells Fargo or Bank of America or Chase. These are really those institutions headquartered in and around the area, and we can see it's fairly split. So we have about as much bank assets as we do credit union assets. So evenly split. And so I just want to take a brief look at some of the performance here. And so I know there's a lot going on with this slide. I'll just kind of try to address the complexity of this a little bit. But really, for our regional banks, we're looking at their income statement. we're going back to 2007 to just get a sense, how did we emerge from the Great Recession to where we are now? Overall, performance has actually been pretty good, right? So, initially you would have thought a low interest rate environment, how are our financial institutions going to deal with that from a margin perspective? But, we've seen deposit rates pretty much go rock bottom, as close to zero as people can get and still keep that liquidity in the form of deposits. But really the column chart kind of overlaid against the area chart there, we're really just looking at income relative to expenses. The net income line below that is really just expressing that difference in another way. But we can see net income has been fairly consistent. There is a peak there in 2019, has to do with some merger activity. I believe that was our local Tri-Counties Bank acquiring a bank up in the northwestern part of California. So kind of impacting the numbers a little bit when we look at those combined institutions. But all in all, not too bad. I just want to quickly point out on the column chart with the area chart, you can see the item provision expense. So that's going to be the blue kind of area, the blue wave, I guess, on top of the red and the yellow. And really, you can see back towards the Great Recession, it was a lot wider because our regional banks were having to, provision for credit losses that they were experiencing and thought they would have to experience. And then we can see just recently in 2020, we see the same thing. We see the widening of that provision expense as our institutions prepare for credit loss. But surprisingly, we haven't really seen it. I think that's a good segue into this next slide where we can see our regional banks. Just what we were talking about, the orange line is going to be that actual level of problem assets. And we can see it's actually remained fairly low. It ticks up a little bit. There might be, some loans that our institutions are worried about, but really relative to where things were, you go back to the Great Recession, in a lot better situation. Quickly, the gray bars next to the blue bars are going to be our total assets relative to loans. So you reverse this, you can get kind of your loans to assets ratio. And what this is getting at is there really aren't probably as many lending opportunities that our local financial institutions would like to have, the good credits that are sound. It can be difficult in this environment to, with all the uncertainty that we've already discussed, to go out there and really take that risk. So it's a meaningful approach. But at the same time, the liquidity has flowed into these institutions so fast that it's hard to lend it out that quickly, right? I mean, I think our regional institutions are doing a good job trying to get that money out into the region, out into our local small businesses to keep things going. But it's just the deposits have flowed in so quickly that it's hard to keep up with. We'll take a quick look at our regional credit unions. Very similar charts, but you can see just a kind of a quick note, the difference between the banks having income higher than the credit unions. Credit unions are not-for-profit entities that are not taxed, so therefore the difference that you might see between those two is really probably the tax expense. But again, looking back into the Great Recession, we could see that there were cases where our regional credit unions were actually losing money on the annual basis. However, things stabilized over the following years. And again, just as we talked about the previous slide, that blue line is kind of inching up over the last several years as concerns about credit loss have increased. However, if we look at the same slide for our regional credit unions, the orange line again showing us that there really aren't problem loans materializing in the way that we might have thought when with the onset of the pandemic. So things have performed fairly well, and if we can get enough momentum with reopening and get things going again, we might be able to dodge what a lot of us thought was a pretty daunting situation when it comes to borrowers' ability to pay their credit on time and satisfactorily paying principal and interest. So things have gone well relative to the impact to the economy, right? So overall, things are good. Again, regional credit unions, loans to assets, having way more deposits than we can lend that money out at the same time. I think, I can kind of speak to Golden One. I know we're, making as many mortgage loans and auto loans as we can, but it's still so much deposits coming in at one time that it's hard to keep up with. And as we mentioned earlier, over the next 6 to 12 months, the question is going to be how fast do all those deposits that built up flow back out to the economy as consumers and businesses invest and spend money with the reopening. So I'll pause there again and see if any questions. I don't see anything popping into the Q&A at this point. We can keep it going and again, get to some questions at the end. So at this point, I'm going to turn it over to my colleague, Nick, who will go into our regional labor markets.
Good afternoon, everyone. Thank you to the El Dorado Community Foundation for having us and to all the attendees for actually watching us. So exciting to be here. Today, I'll be speaking with you about labor markets. First, we'll begin with a look at unemployment rate by region. So we have the United States, California, and the Sacramento metropolitan area, which consists of the El Dorado, Placer, Sacramento, and Yolo counties. We abbreviate MSA for Metropolitan Statistical Area. As of March 31st, 2021, the U.S. unemployment rate was 6.2%. The Sacramento area was a bit higher at 6.9%, and the California unemployment rate was the highest at 8.2%. I don't think it's a huge surprise that California is a bit above the U.S. We, are the strictest state in the nation, probably short of Hawaii with regards to the lockdown, maybe New York as well. The state also tends to be hit harder by economic cycles in general. If you look at the data from last recession, you can see it's well above the U.S. there. What is interesting is, if you look at the last recession data again, Sacramento used to trend more in line with California as a whole. However, following this pandemic, we've actually trended much more closely with the U.S., which is a good sign. It means we're recovering more quickly than the state as a whole. We're more in line with the U.S. That being said, Sacramento isn't exactly a tourist destination. I love it here, but I think a lot of that, is really just, we're not that impacted by the pandemic with respect to the industries that are big here. Moving on to unemployment rate by county. So I mentioned the Sacramento metropolitan area. Now we have the 4 counties that comprise that area. So El Dorado County, Placer County, Sacramento County, and Yolo County. They all look pretty similar. It's what you would expect. As of March 2021, Placer County had the lowest unemployment rate in the region at 5.5%. El Dorado County had the second lowest unemployment rate at 6.3%. Yolo County just behind at 6.4%, and Sacramento County well above the pack at 7.4%. Intuitively, I don't think there are a ton of surprises with these data. Sacramento County's original destination for entertainment, nightlife was halted, the arena was shut down, etc. COVID took a toll on those industries, and the unemployment rate reflects that. I imagine there's also a little bit of political and socioeconomic differences in the region being reflected in these metrics as well. On the other end of the spectrum, Placer County recovered relatively quickly. Things are getting back to pre-pandemic. I don't think we're going to end up immediately there. Our last recovery was something like 12 years in the making. So we have a little ways until we're down to pre-pandemic levels, but we're making headway pretty quickly. I think we're on the right track, especially with California's plans to reopen fully in June, though it seems like that's going more quickly than anticipated. So now we've seen a bit on the unemployment rate. How are we looking from the pre-COVID jump-off point in terms of just total jobs in the region? We initially lost 138,000 jobs in the Sacramento metropolitan area at the onset of the pandemic. It's a pretty big jump. We only had about 1 million to begin with. We're still short about 40,000 jobs. So that's 40,000 people that were working before the pandemic that are not working now. So we still have some recovery to do. I imagine once things open back up and the restaurant jobs come back, the Golden One Center jobs come back, et cetera, we'll start to see that number reach pre-pandemic levels. That being said, I will note that typically we would want this number to increase if we had a flat year. That's not great. So the impact is probably a little more than 40,000 jobs realistically, because this should be an increasing number, not a flat number. I'll just leave that there for what it's worth. Moving on to the next slide. Another important metric is the labor force. So labor force is the number of people that are employed or have looking for work in, I think, the past 2 weeks in the region. It's the denominator in the unemployment rate. And during the last recession, during the recovery, there was a lot of talk about how the unemployment rate was deflated, so lower than it was supposed to be because so many people had dropped out of the labor force. They had been, adversely affected and decided that they, just did not work anymore. So the unemployment rate wasn't capturing that number. So we do want to keep an eye on the labor force to make sure we aren't just seeing a massive dropout in people looking for work. What we see here is the labor force is down about 12,000 people from its pre-COVID jump off, really. Initially, I think that number was, I don't have that number, I think it's 40,000 or so from the jump off. So about 1 in 4 of those missing employment jobs are probably accounted for by those that have left the labor force entirely. I imagine that's also, again, a lot of entertainment industry workers, leisure and hospitality being the big industry there. Nevertheless, the trend looks good. I think we're going to get, back up to pre-COVID levels pretty soon here if things go as planned, assuming, there's a lot of variables. We can't guess the future, but assuming we see more of the same, we should be back up to normal pretty soon. Finally, I wanted to show you how employment is looking by industry within the region. We're moving back up to the metropolitan area level again. We can probably get some of this at the county level, but it would just be too many graphs for anyone to probably care about. But that data is all available from the Bureau of Labor Statistics if you're interested. Before I go into too much detail, I wanted to mention that the pandemic resulted in a serious shift in how people live. Whether that's working from home, eating out less, spending more time with family, people's preferences have shifted in a very real way. I mean, I know my preferences have shifted quite a bit since the pandemic started. So when we see employment figures by industry, some of this is, job losses in industry that will probably come back. In other cases, it might be complete shifts in consumer preferences. What if bars open back up and people decide they like, having barbecues more? Things like that. You might see some level of just shifts in demand. Same with remote work. Are people going to want to go back to the offices? I'm sure Bob has some insights on that he may have included in his presentation, but are people going to go back to work full time? Is there still demand for those kind of things? So there's some structural change here that we don't know the ultimate outcome yet. But maybe there isn't. Maybe everyone just goes back to their pre-COVID ways in another couple months. We'll see how it goes. This graph here is obviously way too busy. Sorry, back one, Jill. This graph here is obviously really busy and probably too small to read, but how we broke out employment by a number of different industries, we'll say that's about 12 industries, I think, 12 major industry codes that are pretty commonly used for these kind of metrics. We have construction, retail, trade, financial activities, et cetera, et cetera. I turned them all into a percentage. So you can see at 100% is where we were at in February of 2020, I believe, the end of February. So we're calling that the pre-pandemic peak. And then we look at the share of that February 2020 number. How has employment held up in that industry? Is that industry doing better off, worse off, or about the same? This is too much to look at, so we've broken it up into 3 categories, and now I'm ready for the next slide, Joe. So first, we have the industries that weren't really that impacted by the pandemic. Obviously, I think we saw a reduction in employment across the board in the first couple of months of the pandemic, and we still see broadly a reduction in employment. As we discussed earlier, we're short about 40,000 jobs. So those are dispersed a little bit of everywhere. But the jobs that the industries we're not really seeing a huge shift in were manufacturing, financial activities, the public sector, wholesale trade, professional and business services, retail trade, and education and health services. So not a ton of trade changes there. I think a lot of those are, that's what we would call essential jobs. There's obviously some fluctuation. I think retail trade, we saw, a big reduction in employment at the beginning of the pandemic, and then now it's getting back to normal. But overall, these are more of the same. We can expect these to probably return to normal once things open back up, and no major shifts here. Next, we have, I guess, the good category. These are industries that have performed relatively well over the past year. Construction took an initial hit, pretty big one, but it's now above pre-COVID levels. Bob might have some insight on that with the real estate side of things, but I'm sure most people in this room have noticed some level of uptick in construction around town, or at the very least, increases in housing prices. Transportation and utilities are also doing really well. I tried to dig a bit deeper into this one, and it looks like utilities employment is about the same. That's relatively stable, and we'd expect that. It's not a very volatile industry. But what was changing were transportation and warehousing. So passenger transportation is down a lot, but shipping and freight transportation are up a lot, which makes more than enough to offset the passenger decrease, which makes sense given the fact that everyone is staying home, shopping online, fixing up their houses, etc. We've also seen a large increase in warehousing employment, which is lumped into this category, and I think goes hand in hand with the online shopping story. Places like Amazon have been very profitable. If you've seen their profits since the pandemic began, I think they're up quite a bit stock-wise. That being said, are these trends here to stay? Construction is very cyclical. That's an up and down industry. We're seeing a shift in, an influx of people from, say, the Bay Area coming into Sacramento, et cetera. Will that last? Will that be prolonged? Will people still want office space in the future? Those are a lot of variables there. I think we can expect that to, be cyclical as usual. Once California opens back up, will online sales taper off? Will transportation and warehousing decrease in employment? Not sure. We'll have to see how that plays out. Obviously, online retailers were gaining a lot of ground on traditional retailers prior to the pandemic. What's left, I think, is pretty strong. Places like Home Depot, where you can't really ship that kind of stuff with ease. But it'll be interesting to see what happens. I know personally I used a lot more delivery services, even food delivery services during the pandemic. We've gone back to the grocery store since things have leveled out, but we'll see what changes. I think that a lot of the growth in these segments is really offset by contraction in sectors on the next slide. So it will ultimately depend on consumer preferences to decide how our employment concentration will look moving forward. Moving on to that slide, we have our industry segments that haven't been doing so well since the pandemic began and continue to lag behind. These are the information sector, leisure and hospitality, and other services. So everyone here knows the story with leisure and hospitality. That's restaurants, arenas, hotels, etc. I think we'll see those recover soon. Did people's preferences shift? Are people going to be eating out less after the pandemic? Will they be going to the bars less, the movies less? I'm not sure. Maybe it'll get a full recovery. Maybe there's a ton of pent-up demand and it will shoot up above pre-recession peaks. I'm not sure here. We'll have to see how that plays out. I do think it'll go up from here. I don't think it'll be flat to down. Next, we have other services. These are auto shops, dry cleaning, personal care, churches, etc. It's kind of a catch-all category for a lot of these segments of the economy. As with leisure and hospitality, I think these are things that we'll see begin to recover once the state opens back up. These are necessities, but they're more correlated with probably travel and work commutes and generally things being open. So I think we'll see those increase. Again, how much the increase is going to be up to consumer preference and how much those have changed over time. Finally, we have information. This sector comprises the publishing industry and information technology. With respect to publishing, the industry has been on a steady decline for years. And early in the pandemic, we saw a big drop in that, which happened to correlate with the McClatchy company going bankrupt in February. So some level of that, I imagine, has to do with the McClatchy company's bankruptcy. I don't think this is an industry we'll see a massive increase in, but I don't think it will drop very quickly either. It'll probably be a continual slow decline as it's seen for the past decade, really. Sorry, I'm looking at my notes here, trying to get back on track. Finally, we have the information sector. This sector comprises, information technology, sorry. Unfortunately, over the past decade, the information technology sector has seen a pretty severe decline in Sacramento for the past 10 years. So the drop that we're seeing here isn't just representative of the pandemic, but overall kind of a structural issue with the Sacramento region. California is not a competitive place with respect to a lot of industries, particularly manufacturing, et cetera. We may be cheap for California, or affordable for California, but we're still located in the state of California. We're not a business-friendly state. And what we are good at here in California is high-skilled, high knowledge-intensive industries. Look at the Bay Area, or think entertainment sectors down in Los Angeles. If Sacramento wants to be successful in the long term, I think the public sector is great to have here. I think it does a lot for our economy, but I think if we want to continue moving upward, we need to figure out how to make use of some of California's comparative advantage and bring over some jobs from the Bay Area and focus more on technology. So this is just a structural issue for Sacramento. When I worked at the Greater Sacramento Economic Council, this was a constant question, but it's a bit of a chicken and egg. IT firms look at Sacramento and they say you have no talent. On the other hand, no talent comes here because there's no jobs. So, do we get the jobs first or do we get the talent first? Luckily, I think the pandemic may actually help with that. A lot of people from the Bay Area are migrating to Sacramento and continuing to work in the Bay Area. My girlfriend works in San Francisco. I think that's a fairly common story, or will become more common. And at some point, if we have enough, tech workers living in Sacramento, maybe companies will actually start opening offices here. I know I've seen a few over the past, few years, but we're really underperforming here, and it shows in the data. And that's about all I had to present here. So those are just kind of my thoughts on the economy. And I don't see any question in the chat, but I'm happy to answer if anyone has any or attempt to. With that being said, I'll pass it off to Bob.
All right, thanks, Nick. So hello, everyone. My name is Bob Shanahan, Research Manager with Colliers, Sacramento. So today I'll be taking you through just a two-part presentation touching on trends in the residential sector, both single family and multifamily, and then moving into commercial real estate, office and industrial real estate. So first, with the housing market, you can go to the next slide there. The housing market's on a tear right now. There are a lot of sales going on, and there are a lot of really kind of eerie parallels between our current market and what was going on in the run-up to the previous bubble bursting. However, I think that there are a lot of different significant changes in what's going on today versus 05, 06. Demand is much more sustainable. You have the millennial generation aging into home ownership, and you have a lot of more strict underwriting standards in terms of trying to get a home loan. So there aren't a bunch of people getting home loans that aren't able to afford them. So we're not seeing any kind of wave of foreclosures and evictions and all that, but there's an eviction moratorium in place, of course, still. But there's a lot of different demand drivers, demographic shifts, and then the pandemic has really kind of forced households to reevaluate not only where they live, but how they live. And so a lot of people have looked to different markets to live in. And Sacramento has benefited from that migration because we were already seeing a lot of Bay Area migration prior to the pandemic. But with the untethering of the tech worker from the physical office, we have seen a strong surge in Bay Area home buyers relocating to the Sacramento region. But some of these stats here, these are from Zillow. So March of 2021 was the largest 1 month increase in home value in the 25 history of the Zillow Home Value Index. And then the 10.6% increase was the highest year-over-year increase in 15 years. There are the amount of homes for sale declined 32% year over year, which is the 18th straight month of declines, and 12 consecutive months of declines of more than 10%. However, the low amount of inventory available for sale has not hampered sales volume. And then 2021, Zillow projects 13.5% increase in sales. And there's potentially more supply coming on the market. I think that a lot of people did not put their homes on the market last year because of pandemic related concerns, and also just not wanting to have to go out in the market. But there are some 8 million homeowners projected to move or sell their home this year, and new listings rose 30% nationwide in March of this year. And we're starting to see new home construction start to pick up to address all of this demand. And then looking regionally, so the pandemic has really accelerated household migration over the last year. With people no longer commuting in the office, people have decided to move. Over 40% of the U.S. workforce was still working from home at the end of last year. I think it's still, close to 40%. And then a lot of people couldn't afford to buy a starter home in their market, but a lot of people could afford to buy a home if they moved to a less expensive locale. And we've seen a lot of that occur here in Sacramento. If you look at those graphs on the right there, the first one shows the annual effective rent change for multifamily properties. So you can see all the red there is the Bay Area. So San Francisco saw a 21% decrease in rents. The San Francisco Peninsula down almost 16%. San Jose, Silicon Valley down 14%. Meanwhile, Sacramento's up 6%. Stockton, Modesto's up almost 8%. And then a similar story with occupancy rates last year in the multifamily sector. You saw San Francisco's occupancy rate decline 6 percentage points. Silicon Valley's down 2.5 percentage points. Meanwhile, Sacramento increased almost a whole percentage point, and Stockton and Modesto increased even more. So I think there is a real great migration underway that was sparked by the pandemic. And I don't think it's going to slow down anytime soon. However, there is some ongoing issues with people coming back into the office and all that sort of stuff. But I think remote work is here to stay, and that's really impacted our housing dynamics here regionally. And then this takes a look at so effective asking rent changes. So you can see there on the left there, Sacramento is the second number 2 market nationally in annual rent growth, 7.4% behind only Riverside in Southern California. And then San Francisco and San Jose were the largest rent decreases nationally last year. And then over there on the right, you can see the monthly net flow out of San Jose on the left, and then San Francisco on the right. So there were already some people moving out of those Bay Area metros prior to the pandemic, but it really accelerated in the summer months of 2020 and continues to this day. And then taking a look at some single family housing stats here locally. So the Sacramento region is seeing some really strong home sales here. The median home price is up to $540,000, which is up 23% year over year through April. The median home price is up 11% in the last 90 days alone from February to April. The average home price, about $609,000, is up about 26% year over year. And our months of supply, only 0.6 months of supply, is down 72% year over year. And homes are getting snatched up very quickly. Only the average days on market was only 14 days, down 72% year over year. Buyers are making offers well above asking prices. Housing supply is about half of what it was last year. And again, sales volume continues to increase despite the lack of inventory to satisfy demand. The sales volume in the $1 million and larger homes increased 127% from July of 2020 to March of 2021. And a lot of these homes have multiple offers and continue to see strong demand in the spring of this year. And then again, just some regional housing market trends. So that graph on the left shows the median price in the Sacramento region. The black bars show the price in April of every year. So as you can see, a substantial spike over the last year. The median home price has increased over $100,000. And this is for the entire Sacramento region. So the 4 counties, Sacramento, Placer, Yolo, and El Dorado. And then the graph there on the right shows the monthly median price in the Sacramento region. And that orange line that's getting started there on the upper left, that's where we are currently. So still continuing to go up. And then looking locally, so El Dorado County has seen some even stronger sales numbers. So looking at Q1 of 2020 versus Q1 of 2021, median prices are up 19%. Average price up 23%, number of sales up almost 16%. The number of cash sales, all cash sales, is up 15%. And then the amount of the days on market is down dramatically, which is a real strong signal of demand. And then looking a little bit farther from February to April, the median price is up to $622,500, which is up 24.5%. The average price is quickly approaching $700,000, which is up 27% year over year. So really, really strong sales numbers for El Dorado County. And then just taking a look at some listings. So that bar graph on the left there shows the columns show the difference in listings in El Dorado County in 2020 versus 2021 by price range. So across all sale price ranges, the number of listings are down dramatically. And then that graph there on the right shows the monthly sales volume in El Dorado County. So 2020 was a really strong start to the year in January and February, but January and February of this year has surpassed that and is on pace to continue to set records. And then again, sales volume in El Dorado County. So similar graphs here, January, February, really, really strong start to the year. Even when this is typically a slower time of year for home sales, we're still seeing really strong numbers. And then even the number of sales that in 2021 in that line graph there on the right shows that it's still keeping pace with 2020's average, with 2020's number of sales. And that black line shows the dramatic spike in the summer months of last year in El Dorado County, which really showed the strong demand throughout El Dorado. So that's it on the residential side. Now I'm going to transition into commercial real estate. So I'm just going to focus on office and industrial. It's really been a tale of 2 diverging markets. The office market is really been hit hard. This graph here shows on a national scale office demand. So this is quarterly net absorption across the country. So in Q1 of 2021, the US office market recorded minus 46 million square feet of net absorption, which is a quarterly record low. And as you can see, the amount of occupancy losses on the office side, about minus 134 million square feet over the last year, is well above the great financial crisis, which had a negative net absorption around negative 92 million square feet. And so, the remote work has really disrupted commercial real estate, and people are still wondering what the future of the office looks like. A lot of people are starting to return people back to the office, but a lot of decisions are still being made, and there's a bit of a tug of war going on between employees wanting to continue working remote and employers that want to bring employees back into the office. So it'll be interesting to see how that all kind of shakes out. But in a sign of demand going the wrong way, the US office market's sublease space increased 55% in 2020 and continued to increase in the first quarter of 2021. And in Sacramento locally, we set a record high, surpassing 1 million square feet of available office sublease space at the end of 2020. And then moving on to industrial here nationally. So industrial has never been stronger. The rise of e-commerce has benefited industrial really well. And then a lot of companies looking to shore up their supply chains. There's been a lot of demand. So our Q1 2021 net absorption of 109 million square feet was a record quarterly high, and is 67% higher than 2020. Asking rents across the country are up 4.2% year over year. Vacancy rate of 5.2%, 34 basis points below the end of 2020. And there's a lot of new product under construction across the country, 355 million square feet, which is up 8% year over year. And a lot of that is getting gobbled up by Amazon, as you could probably guess. So a lot of supply hitting the market. So this takes a look at US industrial supply delivering on a quarterly basis. So as you can see here, since the start of 2016, the US industrial market has delivered above the 10-year quarterly average of 49 million square feet. So a lot of new supply continuing to meet the surging industrial demand across the country. So looking locally, the Sacramento office market. So that graph on the left shows the vacancy rate, new supply, and net absorption. So the Sacramento office market vacancy rate fell to 13.1% at the start of 2020. However, over the course of the last year, it's risen 250 basis points and up to 15.6% in Q1 of 2021. As you can see, those two dark blue bars there in Q4 2020, Q1 of 2021, the net absorption over those 6 months combined to minus 1 million square feet of occupancy losses. So Sacramento recorded minus 511,000 square feet of net absorption in Q1 of 2021, which was lower than all of 2020's net absorption combined. The Q1 net absorption total was the lowest in 20 years. And that graph on the right there shows the annual net absorption, and then compares the overall market vacancy rate, which you can see increasing from 2019 through 2020 and into 2021. But then the downtown Class A vacancy rate. So downtown has been hit especially hard. High rises have really kind of fallen out of favor, and our downtown office occupancy, probably still around 25% of what it was pre-COVID. I mean, still really empty. A lot of the draws that brought people downtown, the bars, the restaurants, Golden One Center, everything being shut down has really kind of hampered people going back into the office. So you can see the downtown Class A vacancy rate increasing, almost increasing twofold from 2019 to 2021. So 5.4% was an all-time low at the end of 2019, but that it has since risen up to almost 10% as of Q1 of 2021. And then in terms of rents and sales on the office side, so that the asking rates graph on the left there shows that asking rents are starting to soften in the downtown Class A market after setting a record high at $337 per square foot full service. In 2019, it has dropped a cent over the last couple of years. And overall asking rates, however, this is just asking rents, actually increased 5% year over year. But market Class A rents, so across the whole 4-county region, those Class A rents dropped 0.4% to $247 per square foot. But on the graph on the right reveals the dramatic drop in sales volume for office assets across the region. So the rolling 12-month sales volume, which is that blue shaded area in the back, you can see the steep drop off from Q1 of 2020 when it hit an all-time high at 1.5 billion, and that was after Park Tower sold in downtown. Since then, 12-month sales volume has dropped to $637 million. And then in Q1 of 2021, we only saw $126 million of sales volume, which was less than half of the 5-year trailing quarterly average. So still a lot of investors leery of investing in the office market with a lot of uncertainty still out there. But average prices over the last month, after not seeing much of a decline in the summer months of 2020, after all is said and done, prices over the last 12 months have dropped 14% to $177 per square foot. And investors have really kind of shifted out of the office asset class altogether and are looking into safer and higher growth asset classes like industrial or multifamily.
Hey Bob, this is Joe. I think I can take the blame for hogging up probably the first part of the presentation here, but I was gonna probably just jump ahead to I think the El Dorado County
okay.
slide.
No worries. Sorry, I wasn't keeping track of time close enough. So I'll finish up here. So looking at El Dorado County, the office market in El Dorado is very small. So for El Dorado, we just track El Dorado Hills, Placerville, Shingle Springs, and Cameron Park. The vacancy rate's around 13%, which is up about 160 basis points year over year. But being such a small submarket, it's susceptible to kind of dramatic swings in asking rents or vacancy rates based off of one small thing happening here or there. So one building hit the market at a higher asking rate. So asking rents went up dramatically over the last quarter to $214 per square foot. El Dorado's office market is generally pretty stable, not a lot of inventory, and a lot of companies decide to locate here because a lot of decision makers happen to live in El Dorado Hills, so it's convenient for them. And then finishing up with the El Dorado industrial market. So El Dorado's industrial market's really strong. You can see some pretty significant rent decreases over the last year, but nothing really to worry about there. That's just asking rents, and really just kind of depends on the quality of space out there on the market. But as of Q1 of 2021, the industrial market in El Dorado was at 3.4%.
All right.
So that's it for me. If you guys have any other questions or if you would like any additional information, there's my contact information there. You can subscribe to any of our market reports. So thank you.
Thanks, Bob. Hey, real quick, I did see a question pop in about what will mortgage lenders do about defaulting loans with government-imposed forbearances. And I know it's hard to speak to the broad picture of what will happen exactly. I can say that I think regulators of mortgage lenders have been trying to be flexible while understanding what the the forbearance situation is. I know, at Golden One, we've had plenty of cases where we've, gone ahead and considered and in some cases allowed for forbearances, given the circumstances, to allow mortgage payments to be made, at a later date. But overall, nothing has happened at this point to where mortgage lenders have seen the losses start to hit, or we haven't seen those credit losses really materialize. I think it's a case where I think the regulatory agencies of the mortgage lenders are going to try to work with them and give them flexibility in handling those credits if they do run into an issue. So it's hard to say exactly what will happen, but it seems like the powers that be are trying to be considerate and work together with the lenders. But with that, I'll leave it there, and Bill, I'll turn it back over to you.
Great. Thank you so much, Joe. Want to thank you all, Nick, Joe, Bob, for your presentation. We appreciate you taking the time to put all the numbers together. You're obviously well informed, and we appreciate that information. I want to thank all of those that have stayed and listened to us. And it's been a good presentation. On behalf of the Eldorado Community Foundation, thank you for joining us. And keep an eye out. We'll have more events that we want you to join us for. But May of 2022, we expect to have an in-person forum, which is always a great event at Serrano. So thank you all for your presentation, and thank you for those who joined us.
Thank you.
Thank you.